You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at @TIWTweets.
Obviously, we've got this standard disclaimer that we normally have, saying that we're not financial advisors, nothing in the show is financial advice. I just wanted to add an extra disclaimer for this interview because Joe actually is a financial advisor. However, nothing in this podcast is financial advice or the interview, and no products, investments, or services are recommended or endorsed by either me or by Joe in the interview. That being said, if you would like financial advice, do feel free to just get in touch with Joe, which you will get the details for in the podcast, or if you want to contact me, I can pass them on to you. Thanks very much.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 18th of February 2025, and I'm rejoined by Joe Kaye, who goes by the username @JoeValue on Twitter/X, depending on what you call it now. So Joe has been on before a couple of years ago. I think it was actually probably pretty much bang on 2 years ago. And I'm going to repost the previous interview just for anyone who wants to have a catch up. But last time Joe came on, it was running a special situations fund. So Joe, firstly, thank you very much for coming back on the show. And secondly, could you just give us a bit of a update of what you've been doing for the past couple of years?
Yeah, thanks Sam for having me on the show. Yeah, so over the last couple of years, what have I been doing? I've been running this special situations fund and my own personal fund. I've also changed careers because I was also an actuary, and now I've switched to financial advice. So there's been quite a lot of change. And then also the special situations aspect of the fund has gone through a transition, I'd say. I invest less in special situations and more in quality and value. So yeah, gone through quite a big investment change in terms of outlook.
What do you think the reason for that change was?
Special situations is great because you find an opportunity, you wait for something to happen, and then it happens, and then you're out. And there's also no buying or there's no selling decision. It's like you either the thing works out or it doesn't work out, and you sell either way. But then that creates a lot of turnover in the portfolio, and you have to keep hunting for the next opportunity, I guess, and that takes up a lot of time. And given that I run the fund on the side, I run this financial advice business as well, I just didn't have the time to dedicate to turning over that many rocks. I prefer to find some really good investments that I can keep for longer periods and that will perform well for a longer period of time. And I think it's just, less time is the main reason for changing.
Was there a turning point where you decided, well, I don't really want to be doing this anymore for the amount of time I'm putting in? Or was it just a gradual thing that kind of just happened on its own?
Yeah, I suppose the turning point was that one of the investments I had did really badly. And that kind of made me think I need to rethink my investment strategy. And I came up with a lot of learning points from it. I spent ages and ages writing things down and considering what had gone wrong and trying to learn every little bit out of it. And the key lessons that I learned from that, which directed me towards this approach more, is that a value-based strategy with really high quality management, great balance sheet, great financials, and a business that has real growth potential is something that I should be aiming for, instead of kind of looking in the weeds and finding all right businesses that have got something going on, that some kind of thing is about to change and the market hasn't priced that in. I feel like before I was looking at things that were much lower quality because something was going on internally that hadn't been priced properly. And now I'm looking at, and I find this better mentally, is looking for really good companies that are run really well, that have aligned management, and that feels better to me.
So could you talk a bit about your career change as well then, and how that came about and why you decided to switch?
Yeah, so when I was working as an actuary, I just found that number crunching and just kind of working in isolation on different projects was not very fulfilling for me. And at the same time, I was doing all the investing, which was very fulfilling, and I loved that. But I was thinking, well, how can I make an impact on people's lives? How can I really give something on a person-to-person basis? And then my dad, who runs an IFA firm, he's looking to retire in the next few years and sell his business. And I thought, well, that's the perfect match. And it uses all the skill sets that I built up so far in terms of, all the stuff about investing and finances, but then it also incorporates that people element of actually just helping people with their retirement planning and tax planning and all that kind of stuff, which really interests me. And so I read this book called Entrepreneurship Through Acquisition, and that kind of really gave me the perspective to even consider buying the business from my dad. I really recommend that book, but it was kind of outlining that it's much more risky to start a business from scratch, and that it's far less risky to buy an existing business and grow it or improve it in some way. And that it outlined how you would go about buying an existing business, which I'd never considered before. And I think one of the key things there, which enabled me to even consider this career change, was the structures that you can use to buy an existing business, which in particular seller financing, which is a whole area in itself, but it means that you don't need to come up with a big loan or lump sum to buy the business, but you actually pay back the seller over a number of years from the profits of the business. And that, just reading that book, gave me a mental shift to actually, make it happen. Otherwise, I wouldn't have been able to make that career change knowing the massive pay cut that I would have had to take. So it was a number of things, but it kind of led me to something that running a business or being part of a business that had much more meaning and fulfillment to me than doing the actuarial. And I also get to do the investments alongside the IFA work as well. So it's kind of a win-win.
Is that entrepreneurship through acquisition? I don't know if it goes into specifics or not, but kind of is it UK focused or?
No, I don't think it is UK focused. It's not to do with like UK tax laws or anything. It's just a very good guide as to what's possible. It just opened my.
How have you found it then, working as an IFA?
Yeah, it's really fulfilling. I really enjoy working with people. There's such nice clients, all from different backgrounds, obviously quite successful people, very successful people in their own rights, doing all sorts of different businesses or industries. And it's having that people connection that I really enjoy. And then also just quantifying how much I can help them. I love that. It's just like, I've been able to save that person X amount of tax just by, the planning that I've done, or I've improved their investment strategy and they've got far better investment return with lower risk. And it's just really satisfying for me to see the impact that I can have on people, and also like explaining their current financial situation to enable them to maybe make a gift earlier to their children or grandchildren because they realize that they have too much, well, they have enough money that they can last for the rest of their lifetime, and then still gift while they're alive. So that, that's a really nice thing to do. Yeah, there's lots to it. And then also working with my dad has been great. Really enjoyed that. And we've been able to grow it even in the last year that I've been working there. We've been able to grow it enough to actually bring on my brother as well. So it's kind of been a real family business. But it's just the whole ethos of like looking after a group of individuals is something that just is very fulfilling for me.
So what does a typical day look like in terms of what kind of things are you advising on the most?
So I think the place where we add the most value to clients and the thing that we really specialize in is the investment management and the tax planning. So the tax planning in terms of like pension contributions, ISAs, and all those kind of normal stuff, plus all the inheritance tax planning, which saves people, typical clients, hundreds of thousands, if not millions, just by putting things into trusts. So we're often doing offshore investment bonds under trust, and there's all sorts of different types of trusts. Yeah, and then there's venture capital trusts, which you can use to offset your income tax. There's business relief schemes as well. So if you're quite elderly and you don't have much longer to live and you want to pass down your estate free from inheritance tax or reduce the inheritance tax bill, you can do a business relief scheme, and that after 2 years it qualifies for exemption from inheritance tax. So there's loads to do, and it's kind of all optimizing, and it's not necessarily like one shoe fits all, but it's like a bit of each and a bit of, it's fun, that kind of optimization strategy.
How do you find the regulatory side of it?
In terms of the investment strategy?
Yeah, do you ever find that like regulation sort of dictates what you're having to do more than what you would actually do if you had a total free rein to advise the clients?
Most of the clients that we advise are not high risk clients. They don't like interesting racy investments like the kind that obviously I do through my fund. They want to protect their wealth. They've built it up over the generations, and they want a steady return with low volatility. So they're not looking for anything with the potential for very high returns. So what works best is actually funds or investment trusts or collectives, which kind of, you get a very diversified exposure to different sectors and different regions. And that helps smooth over the volatility. So it's mainly about reducing the volatility, but maximizing the return for a good price. And what the regulation has led us to do is that whereas we used to recommend managed funds directly to clients, the regulation is much more restrictive in terms of the amount of red tape. When you do, you can still do that, but we've found that actually it's much better to work with a discretionary manager and have them choose the investments for our clients instead. And we've found an incredible investment manager, Albert E. Sharp, and they're quite small. So what they're able to do is they're able to invest in investment trusts, which most of the big IFA firms can't do. So it's a real unique selling point there. And the benefit of investment trusts is that you get the same exposure to the underlying assets as you would in an OEIC, but you get them at a discount. Most of the investment trusts trade at a discount to NAV, and they can also use a bit of gearing as well. So you're getting more for your money there. And then with the discretionary investment management, you get active management as well. So you can take advantage of various opportunities that come up in the market. So when there was that gilt crisis like a year and a bit ago, able to buy gilts at a very good rate and actually get rid of the fixed interest funds and buy gilts instead. So that lowered the risk and increased the returns, which was pretty cool. Yeah. And then also the active management enables you to manage your portfolio. Like at the moment, Albert E. Sharp are kind of concerned about the bubble that's kind of with the Magnificent Seven. So although we do have exposure to them, we wouldn't have as much exposure as you would if you just bought an index tracking fund, even a global index tracking fund, because some of those global index tracking funds have 70% allocation to the US. So it's just really great management for clients. That's kind of the key there, right? So I don't feel like we're not able to offer the things that clients want. I think we are very much able to offer the option that we think is best for the clients. But that is the benefit of being an independent financial advisor versus, a tied advisor like St. James's Place, where you have to offer just the St. James's Place funds, for example. And those funds aren't very high performing. And so then you kind of go, well, the fees, paying top dollar, but you're also getting a fund that's not performing very well. So that's where I'd say clients aren't getting great value. But if you're going to pay a fair price and get really good returns or better than average returns over the long run, I think that's effectively what clients are after.
Yeah, so I think the St. James's Place is a good example. My own anecdotal experience with a lot of them, where they'll go in, they'll do a questionnaire, and they'll just end up with a load of funds, and they will just end up with so many funds that there's no realistic prospects of outperforming the market, which is fine because not everyone would want to do that. But then you just kind of look at it and you're like, well, the IFA is charging a fee. The funds aren't doing this for free. So there's going to be, you're just layering fees upon fees for what is probably at best a market return because of the number of funds in there. So with your discretionary manager, can they pick individual stocks, or would they also be picking funds?
Yeah, so I mean, they can pick individual stocks.
They have the freedom to pick whatever they like, basically.
Yeah, the thing with St James's Place is if you look at the net returns after fees, they're really poor. And I've done this analysis very recently because we've just had a Big Four accounting firm partner joiner, and their standard recommendation for all their partners is, I'm not saying which Big Four firm, but to go with St James's Place. And so he's looked at the analysis and come with us, but it's just like, it's very clear when you look at the net returns. The fee structure is incredibly ambiguous and opaque, but when you look at the net returns, they're pretty awful.
So, I mean, and as well, I do want to be clear, like, I'm not, I know it's just like a random one we brought up. I'm not picking on St James's Place. I think it's an industry-wide issue. Certainly in my own work, I've seen a lot of different firms that seem to offer incredibly similar products that don't really do anything other than kind of collect fees for the IFA. But yeah, the discretionary management sounds a lot better, because I've never seen one like that where there's actually someone in there that's really. I mean, occasionally, I guess when you get occasionally you'll get someone who's managing money where like a client will follow them, and they'll follow them across a few places, and you can tell by the returns they know what they're doing. But like people like that generally seem quite few and far between. I've always found it very, very difficult recommending IFAs to clients, just because most of them, I think, if you actually, I mean, where I used to work, there was a firm of IFAs next door, and it was like, if you went through and tried to talk to them about the stock market or something like that, you'd just draw a load of blanks. If you went in and tried to talk about how much the commission was last month, they wouldn't shut up. And you'd see all the cars parked outside and stuff, and you just kind of think, well, are they really acting in the best interest of the clients? And maybe they were, but with a lot of them, I did have my doubts. So.
It's surprising that, like, how little they're interested in actually the investment side of it and the investment returns. And that's what's great coming from my background of like the investment fund that I run and all the investment analysis and like the fundamental analysis that I do. And then speaking with the chief investment officer of Albert E. Sharp and the kind of views that he has of the market and all the knowledge that he has of the businesses and everything. I know that he's talking his stuff because he makes complete sense. So I know that, you know, he's really managing it from a very fund manager perspective. I know that he's doing a great job because I can see what he's doing.
Yeah, he's actually engaging with it. He's not just it's not just a job. He's not just going through the motions like a lot.
No,
of people.
exactly, and it's his firm, so he's very wants to make sure. He says he lives and dies by his returns.
I've never heard someone in the financial advice industry say that before in my life.
Well, yeah, I suppose it's a different side of the game, but yeah, I
think it is. Yeah,
he runs the firm, and like, you know, if he gets a series of bad results, then I'm sure a lot of people would leave. But yeah, he's got very good returns, and I just really like his approach, and that's what's great about coming from a fundamental investor's point of view, is that you can actually independently assess it and make sure that it is good quality. And I know what you mean, because I've seen a load of things where they just chuck a whole load of funds in and just go, oh, that's diversification, but it's like, no, that's not. There's so much overlap there.
Yeah. It's just the layers of fees they're adding in as well, because it's not even like they're low cost funds a lot of the time. So, well, a lot of these clients could probably go out and just buy a few of these funds themselves. And
yeah,
like, you know what I mean? What are they really paying for?
Yeah, what are they paying for? And they're like, I was looking at an ESG fund because we've got some ESG clients, and they you know, they want exposure to some green stuff. And the fund like that's provided by Tatton, they've got this ethical fund, and it's got like 10 index tracker fund ESG funds and whatever. And you look at them and you look at the quality of them, and some of them are really poor. And then one of them, which is super cheap and like got decent returns, is basically backing up the entire thing. So it's like, well, why are you buying these 10 little things when you could just buy the one index tracker that would sort you out?
Well, that's the thing, because a lot of the time it's like, well, if you buy one index, you're basically diversified. I know it's like you might have like a UK index and you've got no global diversification, but for the most part, it's, you know, when you just layer in all this stuff on top of each other, all you're really doing is kind of driving down the returns, because you get to a point where you're at best going to do the average, and then you've got to take off all the layers of fees that you've added in, probably paying for the privilege of underperformance. Probably at this point, it's probably worth mentioning, could you actually give a bit of a plug But the name of the firm for it, I don't think you'll get a huge amount from this anyway, because I think we tend to attract listeners who manage their own money, unfortunately. But
Well, yeah.
if you want to give it a plug, you may as well.
Yeah, no, I'm not particularly fussed about getting any new clients, but it's interesting because I think the people that manage their own money will want to manage their own money going forward, and that makes complete sense. And I'm like that as well. Like and I have been since I've been running the fund. It's like, why would I need a financial advisor? Because I know what I'm doing. But there are various things that you can't do without a financial advisor that are actually very, very beneficial to, like, inheritance tax planning or something that make complete financial sense. And I wasn't aware of that, even though I thought I was very financially savvy a few years ago. But coming into the financial advice business, I realized actually there's a lot of options that I was definitely not aware of before, like inheritance tax planning and that kind of thing, where, you could put a large lump sum into an offshore investment bond under trust, and it would go outside of your estate after 7 years. But you could do like a discounted gift trust where you get upfront reduction in the IHT liability. And these kind of tools that you can only do through an IFA can save you like 40% tax, which is massive. Obviously, there are other ways of doing it. You can do direct gifts yourself and whatever. But the point is that I wouldn't necessarily just discount financial advice just because I know what I'm doing and I like the way I invest, because there are actual potential opportunities. But anyway, the firm name is Jeremy Kaye Portfolio Management. My dad's been running the business for the last 35 years, and he got his group of clients, and that's it. Like he's got manages like 60 or 70 families or something. And that's enough work for him. And he really enjoys looking after them, the quality and the time to look after them. And he doesn't have capacity to take anymore. And he didn't want to grow it into a big business. So he's been closed to new business for the last 15 years or something, or 20 years. And then just like looks after the next generation, passing down wealth to the next generation. But I think that's what happens with a lot of good IFAs, is that they get to capacity and then they don't have capacity to bring any more people on, because you have to manage them yourself, obviously, or you bring up staff to train up, but that's a different thing. But yeah, now that I've come on board, I'm creating more capacity, and I'm modernizing the systems and automating things and looking at AI to improve our efficiency and everything. So yeah, we do have some capacity, and yeah, I'm happy to have a chat with anyone. But like, we're not on like a massive marketing strategy, and we're not desperate to get new clients, but very happy to help. And that's kind of why I'm doing it, is because I enjoy helping people.
How have you found it then, going out and trying to grow the business and acquiring new clients? Because it's not quite the same, but where I worked previously, there was a guy just before I left, and he went and set up on his own. He set up his own accountancy practice. And he said that he actually sort of couldn't believe how easy it was to go and acquire clients, because he basically said if you go and have a chat to someone who's running a business, they want someone who's interested and cares. And like, once they actually find out you're a new accountant, you're open for business, and they've kind of had a chat to you and got a sense that you know what you're talking about, people were actually pretty keen to move stuff over. So it was very shortly after starting this business, he's basically said he's closed to new business now, unless it's kind of a grade A client. So I was just wondering if you'd found something similar, given that the industries are fairly similar.
I think that's what happens. I think you quickly build up to capacity, and then you're like, okay, that's me done. I don't know if that's necessarily the right way of running business. I think there might be other ways. I'd like to explore other ways of like training up people, so then really I'd spend much more time on the client facing side and create more capacity that way, or really train up some great people. I think my brother's going to be a great advisor, so that will be another avenue of increased capacity of the firm. But it's incredibly easy to win new business, it seems, because firstly, you've got the referrals that keep coming through, and we've had to turn them down previously, but now we can say, yeah, we'll take on referrals. And then you've got, just through talking to different people, they're like, oh yeah, I've got something I can recommend you. And like, especially the investment managers at the firm and the discretionary management firm and stuff. Yeah, the thing is that there is a shortage of good advisors, and there's a shortage of advisors in general. So, and a lot of the advisors that are very good and have been running their client base for a long time, they're coming up to retirement. So there's not that much new blood going into it. So yeah, all of that whole dynamic, and then there's an aging population, and the wealth obviously accumulates as you get older. So there's a lot out there to manage. So I think in that respect, when I was looking at buying the business, it's like, well, this is a really high quality business, very strong recurring revenue, and it's a massive growing demand. It's growth area. So it's like it ticked all my boxes in terms of what kind of business would I want to invest in. But yeah, you're right. It's very easy to grow, it seems.
I'm surprised you said there's a shortage of IFAs. Is that quality ones or just generally?
The thing is that there's a lot of different types of IFAs, and I think it's easy to just say, oh, they're all one thing, but I think they're quite different because you've got the tied advisors, but there's probably a lot of tied advisors, and then.
So could you just explain what a tied advisor is?
So the tied advisor is where you're working for a big company like St. James's Place, and then you can only offer the products at St. James's Place.
Yeah, so whatever your problem is, the solution is a St. James's Place product.
Yeah, and they can't offer outside that. Whereas with an independent financial advisor, we have access to the whole of the market, so we can look at what is the best fund and what are your best options, and provide much more bespoke solutions and options that aren't necessarily available with the tied advisor. In terms of independent financial advisors, I haven't run the maths actually on what the market dynamic is, but I know that there's a huge amount of aging independent financial advisors. The number of IFAs hasn't increased, but the demand for them has.
What's been your experience then going in then and having to, because you've mentioned off air, you're obviously having to, although you do know what you're talking about in terms of the investing side of it, you have to go and get the qualifications before you can acquire the business. So how have you found going through those qualifications, and have you found them to be useful?
Yeah, I mean, I found the tax module really interesting because, like I said, I thought that I knew a lot about finances, but actually there was a huge amount that I didn't know. So that was fascinating. The exams were fine. I mean, they're much easier than the actuarial exams, so that's a plus.
Are you still going through them, or have you now done them?
I've done the last one. I sat the last one last month, actually.
Congratulations.
Yeah, thanks. They're hard enough to, and they're chunky enough to really be like kind of a barrier to entry, or you need to know quite a lot to pass them. So I think that's a good thing. It's difficult for people to switch careers into it potentially.
So could we talk a bit about, you mentioned business relief schemes. So I'm assuming you're talking about AIM kind of listed securities to get the business property relief after 2 years. Firstly, could you just talk about what's kind of in those and how those shares, because again, I've seen loads of these offered. And the general consensus seems to be from the IFAs, well, don't worry too much about the performance, because as long as it goes down less than 40%, you've won. Rather than actually, again, I've not come across one where someone's saying, well, actually, we're going through these AIM-listed businesses, or potentially even unlisted businesses, I guess, as well. But like, we are picking the highest quality ones, and this is the process we've got. And again, it seems like that people get drawn in by the tax savings, but I do question the investment performance for a lot of the ones I've seen. So there's that side of it. And then secondly, what impact, if anything, have you seen so far from clients as a result of the announcement that they're dropping to 50% inheritance tax relief?
Yeah, great question. Okay, so the business relief schemes, we don't really like the AIM schemes. So we like the unlisted business relief scheme. So you're buying, an unlisted business or a group of unlisted businesses. There's some incredible firms out there that have unlisted businesses, but they've specifically chosen them for business relief. So they're very safe, generally safe businesses that are like free cash flow generating, quite large, often in areas like wind and like land and property lending or property development. Yes, so I've looked through them and I've seen like quite a wide range of different investments that look quite safe to me. And they've got consistent returns, like not high returns, but like kind of 5%-ish returns a year. And certainly I haven't seen much, if any, negative returns on the good ones that we've been looking at. I haven't seen any negative ones, so any negative returns on those. But so those are much lower risk than I initially thought, because I kind of had the similar opinion as you. It's like, oh, well, if you're not losing money, then it's probably still all right. But actually, no, these are kind of businesses that they're looking to like grow at like 3%, I think, or something. They don't have high ambitions, but what they do have is a big buffer of cash, because when someone wants to put money into a business relief scheme, they put in the money, and then the business relief scheme manager has up to 2 years to invest into new businesses. And so what they do is they try and keep as much cash buffer as possible, obviously because they have to pay out regularly as well when people die. So there's actually quite a lot of cash on that portfolio that they manage. So that reduces the risk even further. And yeah, I mean, I don't like the AIM stuff because I think AIM is, as overall, is very high risk. And then what was the second question?
So you've now got for the business relief, you've got the £1 million limit at 100% per person, and then it drops to 50 thereafter, and whether that's made any difference.
We don't really have many clients that have more than £1 million in a business relief scheme. Most of our clients do the business planning or the inheritance tax planning earlier than they need a business relief scheme. So a business relief scheme is like the 2 years and then you get exempt from IHT. Whereas if you've got 7 years, if you think you're going to likely to live more than 7 years, then you've got more options. And so, discounted gift trust is one of our preferable options, where you get an immediate discount to inheritance tax. And then the usual potentially exempt transfer over 7 years, you gradually reduce the inheritance tax there. So I haven't found that that's been an issue, because we do if you have AIM, then it's going to drop to 50%. But at the moment with the unlisted, it's 100% up to £1 million, 100% discount on inheritance tax up to £1 million.
For a lot of people though, I'd have thought it doesn't take long before, I suppose if you've got a partner, it's £1 million each, but I was just wondering, because there must be a chunk of people where they'd gone and put, like I was looking at something at work the other day and it was an estate or something like that. But basically, I'm making up a number here, but someone had passed away a few years ago. They had 10 million quid and the lot was in one of these schemes. So whether it was AIM or unlisted, that would now be a fundamentally different IHT position. And I was just wondering whether you thought that would make a difference. But I guess there's also the issue that 50% is better than zero.
Yeah, 50% is a lot better than zero. Our main clients vary between 1 and 8 million in assets under management. So I suppose we're dealing in different ranges of net worth of clients, but we could accommodate, high net worth clients. And actually that's the area that we want to go into or increase, because we do seem to be getting a lot more referrals in the just under 10 million mark. But yeah, we have capacity to manage those kind of clients. And that's actually where we find it the most interesting work and the best value for our clients.
I think with those sides of the estates, there's just so much that you can do usually, especially if they're liquid.
Yeah.
That probably brings us quite nicely into the next point I want to talk about. Could you talk a bit about VCTs, venture capital trusts, and EIS/SEIS schemes? What your experience is with these? Because again, I only see one side of it, because I only really see it, the tax side, but EIS in particular, most of the time, it's just, I know you do very, very well on the tax side, but most of them perform incredibly poorly. There was one guy I interviewed a few years ago who had actually done quite well on EIS, but this guy was, so he's actually, have you come across Seven Investing?
No.
It was like an American service that was set up as like a competitor to Motley Fool. So it was a load of ex-Motley Fool guys at the beginning. And they brought a guy on. He was UK based. He was a guy called Luke Hallard. He's excellent. Some of his returns are just absolutely astronomical. Yeah. And he retired early because his portfolio had done so well. He talks about it in the interview, but he basically went round to like investors events and stuff like that in his free time. And because he was doing the EIS investing, he was actually going to these investment days where they were kind of pitching and stuff like that. So he was actually going in and he was doing sort of a granular level of research that most people don't do with EIS investments. And he had some, or I think he'd had one in particular that performed very well, and that had made up for kind of all the others. But other than that, it's pretty rare that I'd see a client where they've done EIS and actually they've, even with the tax reliefs included, that they've actually had a win on it. It's pretty rare. So I was just wondering what your experience is with those as well.
Yeah, I mean, I've been researching them recently and I'd love it for it to be a great offering, but the EIS is just certainly not suitable for my client base. It's just too high risk. And yeah, we just wouldn't offer them. And same with the SEIS is even more risky. But it's just, as you say, like if they work amazingly well, but you just don't want to risk you don't want to risk that, and you don't want to risk the relationship with the client. And I mean, the client never wants that kind of level of risk in my experience, or maybe the types of clients that we have. But the venture capital trust is quite different to the EIS in that it's spread across a lot more companies. You have a much greater diversification there. It's still got a fair amount of risk on it. You get the 30% income tax relief up front, which is really nice. I'm not going to spell out what the whole benefits are and whatever, but yeah, you have to hold it for 5 years. But I did all the calculations. In fact, I've got a spreadsheet that I did all the calculations with, and I was just looking at one of them, which was one of the Apollo funds, VCTs. And over the 5-year period, they're kind of average 7% a year total investment return over the 5 years. And that works out very well, as in net of tax and then tax benefits, and assuming that you invest that 30% tax relief back in and it gets a 5.5% return, you're kind of equivalent to investing a 12% return on a normal general investment account. So you'd have to get a 12% annualized return to match what the VCT did over those 5 years. And okay, that's based on the VCT performing at 7.4%, I think it was. But if you reduce that amount of performance down to 3% a year instead of the 7%, you still end up with a 40% gain after 5 years.
Just to confirm, you're talking about a 3% return. So in terms of just the pure return on investment, and as well, you're getting the 30% tax relief up front.
That's right, yeah. So, yeah, then you end up with a 40% return, whereas to get a 40% return with GIA, you need 9% or something, annualized return. If the VCT lost 3% a year over the 5 years, that would be equivalent to a 5% return per year on a general investment account, taking into account the net effects of tax relief. So, yeah, I mean, if the VCT did awfully, then yeah, obviously you're going to lose. If it did badly, as in less than a negative 3% return over the period, you're still not really that bad off, because you would have got a 5% return elsewhere in a general investment account. I mean, that's roughly how the math stacks up for me, the analysis that I've done. And then looking at the past performance of the VCTs, I can't really see any that what they do is they pay out dividends, and then the net asset value kind of stays flat because the dividends are tax free. So they kind of just pay it out, and people love receiving tax free dividends, and then they get their money back at the end of the 5 years. And that's kind of what I've seen played out on the best VCTs that are out there. So I think it's fairly consistent. But yeah, I'm not saying it's low risk, but it's a very nice thing to do if you've got a very large income tax bill. That's an option. And again, that's something that you can only do really through an advisor, or if you go directly to, say, Octopus, you pay a extra 3% fee if you're not through an advisor. And we wouldn't charge you a 3% fee for that. So it's effectively cheaper to go through an advisor to get those products.
I mean, in fairness with the VCT, they were kind of lumping them in with EIS and SEIS just because on the tax side, the relief works in similar ways. But yeah, I agree the EIS and SEIS are inherently more risky. I had a guy once, and he'd maxed out his EIS relief for the year, and then he kept going. So we called him in for a meeting, and we were like, what are you doing, kind of thing. And he was just like, oh, I know I've maxed out the tax relief, but I just think they're such great investments. Can we talk a bit about pensions? So yeah. I'm sure you have lots of clients. They've got nice SIPs that they've built up that until a few months ago were outside of their estates for inheritance tax. And now all of a sudden, not only are they going to be inside the estate, but they've got to pay, in most cases, 40 or 45% to actually get the money out the pension to then decide what they're going to do with it. So how have your clients kind of reacted to that, and what sort of things are you seeing?
A lot of our clients have defined benefit schemes, so there's not much you can do there.
Oh, really?
Yeah. We've got a lot of ex-BBC clients, executives and stuff, because my dad used to be the the main advisor for the BBC. And that's kind of where we got the majority of our clients. So a lot of them have defined benefits. But with the ones with large SIPs, I mean, obviously we're saying take the tax-free cash and put that in an offshore investment bond under trust. And then you get that outside your estate. So you get 25% outside your estate. And then in the offshore investment bond, that obviously rolls up free from income tax and capital gains. And then they get a nice tax-free income from that. So you can take 5% of the initial capital invested each year for the next 20 years. And that's tax-free. But then any gains above the initial amount invested are taxable at the marginal income tax rate. You can leave it all. You don't have to take the tax to 5% each year, and it can just grow tax-free offshore and then pass on to your beneficiaries. So that's a really nice inheritance tax planning tool. And it's just kind of an easy win to take 25% out of the pension and put it straight into an offshore investment bond, especially if they don't need that cash and they're going to pass it on to their children, grandchildren, or whatever. And also that the bond runs, you can have it running for many years rather than just on the life assured of the settler. But anyway, like that's one thing that clients are definitely doing. I think actually some of our like high income clients, we're still recommending that they contribute to the pension because of the tax saving going into the pension. So although it's not, massively efficient for inheritance tax.
I suppose it's just wait for the legislation anyway, but have you seen anywhere people are considering sort of shifting the assets held within the pension itself to at least try and get, if you put it all in AIM funds, for example, or AIM shares, you might get 50% still, depending on exactly how the legislation works when it comes out. But I don't see logically why you wouldn't. Which I suppose, again, it goes back to, 50% is better than zero.
Yeah, I mean, it depends on the risk profile of the client, really. Like a lot of our clients wouldn't have that risk profile. But it depends on the tax saving that you can make.
Well, in fact, you'd mentioned as well, in terms of what we were going to discuss when we were chatting about that, you said you wanted to talk about your strategy and like the reason why you're investing.
Yeah.
So has that changed in the last couple of years then?
Yeah, it has, yeah. The reason why I'm investing, I mean, you read all these books about, how to invest and all the lessons learned, and they're fantastic and they're written by incredible people that have got great returns and amazing wisdom to pass down. And I think some of the lessons you can learn just from reading a book, and some of them you have to experience. Even though you know that to be true, you have to experience it yourself and discover, make that mistake and then learn from it yourself. And I think there's been a number of experiences that I've had that I've known to be true and still done it anyway, as in like the ultimate in terms of investing is to take emotion out of it. And if you can be free from your emotions of investing, then you become a lot better investor. You can sell things much easier, like you're a loss from it, but it's not making rational sense. But then one of the big things that I did was confirmation bias, like looking for everything to confirm that I was right to continue holding it and that it made a lot of sense, and kind of almost not making up, but like really wanting to believe the things that would make it right. Whereas actually, if I had have removed my emotion, I would have been able to make more rational decisions. And so one of the things that was affecting me was position size. So when a position size becomes too big, that does impact my emotions. And so I've had to do that recently, where I've had a really great position and I still believe in the investment thesis and think that it has a long way to go, but I've had to basically cut it in half because it became like 56% of my portfolio, and I was like, that the swings day to day were just too much for me. It was stopping me thinking rationally about it or taking up too much of my mind space, like just constantly on my mind. And I don't think that's good for an investment perspective. But then kind of taking a step back, like what makes you emotional about your investing? And I think one of the things is, why are you investing? Well, like if you're investing, for example, people that want to get rich quickly or meet a certain goal, like I must get to X million or whatever, something that you think you need or you really want. Why are you doing that? And then you kind of take a step further back and you go, oh, why is that important to me? And actually, for me anyway, and probably for most people, it comes back to a self-worth thing. Maybe there are other elements to it, like financial security and looking after yourself in the long run and looking after your family and all that kind of stuff. But I think a big part of it is actually tied to the ego and why do you want to become super wealthy? It was probably because, for example, for me, I felt that it would make me feel more important or more higher worth or something, which is silly. And when you look at it like that, and, I can see that was a stupid thing to think. Kind of, I've psychoanalyzed it and trying to figure out where that comes from. And I can see that as a child growing up or at school, I had a tough time and I wanted to feel more important. And then I equated money with success and success with status. And so I was kind of after that. And then I realized that's ridiculous. And that's also based on my 15-year-old point of view or whatever when I needed that. And actually I don't need that anymore. So when you can realize what's driving your need for the investments or the investment return, then you can kind of take a step back and go, well, is that necessary? And if that's not necessary, you can actually take the pressure off it and make it mean less to you. So I think with your status, for example, if you had investments and you thought that made you feel important, it's incredibly emotional to you if they go up and down. You feel great if they go up because yes, you'll get your status is going up. And if they go down, you feel like shit or whatever because you're not performing and you're not whatever, and you don't feel as good about yourself or whatever. And there's always also no limit to that, as in you can always want to perform more, and it's not about the amount, it's just about increasing it. So when you kind of take out that and you go, well, I'm happy with where I'm at and I want to keep growing, keep learning, and keep performing, but not because of those reasons, you can take out a lot of, or whatever that emotion is that you have around investing. If you're able to identify it and reduce it, I'm not saying just eliminate it overnight, because I don't think that's possible. But if you're aware of it and you bring consciousness to it, you can actually reduce that impact that it has on you, and then you can become a better, more rational investor. So I think that kind of self-reflection period that I've had has really helped me with something which is, I think, an incredibly large area of investing. And it's helped me focus on how do I want to allocate capital, and going back from the turning over rocks and trying to find companies that are struggling or companies that aren't doing so well, but they will do well in the future or whatever. I'd actually prefer to invest in companies that are growing, that have got a really strong balance sheet, that are well run by caring management, that have a big stake in the business, and that is incredibly good value at that current price. I don't like buying high PE stock, but I will go up to even 15 times EBIT if it's a fast growing, high margin business with really well run. So it's kind of it's just changed my priorities. I'm not trying to look for that 10 bagger or 100 bagger or whatever to make me feel better, because I don't need to feel better in that way. And so that's kind of turned the investing mindset for me around and made it much more relaxed and much more easy, but also actually much better in terms of performance.
Why would you say you invest now then?
Firstly, I love investing because I get to research loads of different businesses. I love treasure hunting. I love trying to optimize things. And you find a good business. I research stocks globally and in all industries. And you kind of go, oh, that's interesting. What's that business do? And then it's the whole process. It's like a massive game a mental game. It's an incredible mental game. And then I also work with an investing partner. We've been working from the start together, and we've read all the same books, or he's probably read more books than I have now because got way more time for that. But we bounce ideas off each other constantly. Every day we're always talking about different businesses, and we run our bespoke screen. and go through different names together, and we find interesting things and like try and kill the ideas, and we try and play devil's advocate with each other on it. And you get to meet interesting people, and you get to talk to people like you and, you know, other investors that are around the world really, and have really interesting connections. So I think all of that it's the challenge of it, rather than seeing it as a way to get rich. It's more how to enjoy it and how to play the game well. And it's not optimized for the maximum return. It's optimized for the best return I can achieve, doing it in a comfortable way that I enjoy.
How have you found it psychologically? I suppose it's going to be no different because you were doing the fund, but when you're going out and you meet with the clients and it's actually their money that you're looking after rather than your own, do you find a difference psychologically?
Yeah, I do. I want to be more cautious with other people's money because I just want to look after them and I don't want to scare them. And winning for them is getting a really good, consistent return. And for me, it's slightly more optimized than that. And I want to kind of push the boat out a bit more when I find something that's really incredible. Then I'll go up to, well, yeah, I mean, I've set a new limit now, which is like that I won't take a position size that's more than 30% at cost. I know that sounds incredibly large, but before it was much larger. So, and generally I try and keep clients to less than 20% in a position, unless it's like super low risk. Yeah, I try and be a bit more cautious with clients.
Going back to the notes from before the podcast, you've put some stuff in. I'm not fully sure. I'm assuming they were cues for you rather than me, because some of them don't mean a lot to me. But NTPIF, I'm not sure what that is, but you put that as something you wanted to discuss.
All right, yeah, sorry. No, that is an equity. NTPIF is Namtai Property Funds, and it's just part of the special situations fund or investment strategy that I was running before. And it kind of outlined to me what doesn't work about special situations investing that doesn't work for me. I think it works in general, and I think it can be great, especially if you've got a whole load of those type of opportunities. But this was kind of like high upside, high downside type thing, but the upside was so massive that the expected present value was still very positive. And so that kind of misled me in that investment, I think. And it was a big legal dispute with the CEO running off with the chops of the business, basically the control of the business. And it went to international court in Cayman Islands, I think. And the company now has won back the control of the business and sued the people that were being crazy in China. But it was a bit of an emotional roller coaster, and it went dark for like a good year and a half, like as in no reports at all. And now it's trading on the over-the-counter expert market in the US, which basically is untradeable. Almost no people have access to that. And given that the properties are worth, I can't remember off the top of my head, but I think a few billion, like 5 billion, and it trades maybe £1,000 a day or something like that. It's just that there's no volume there at all. But yeah, I've moved away from the dynamic of going for something that has high upside, but potentially quite high downside. I'm just skipping that high downside. But if there's anything that's got high downside, it's not interesting to me anymore.
You talk about GTX and what you've learned from that.
Yeah, so that was one of my first really big investments. And talk about position size, that was pretty big because I initially put like 25% of my savings into that. And I bought that during bankruptcy. So it had massive selling pressure. It was a voluntary bankruptcy because they were trying to negotiate a legal dispute with the spin-off company, Honeywell, which they were clearly going to win, but it was just like, how much? But basically, it was a special situation. You've got a big company's voluntary going into bankruptcy. Therefore, all the funds, all the big institutions have to sell it because they can't hold a company that's in bankruptcy. You get massive forced selling. Then we bought it, and I bought it at an incredible price for the quality of the business that was definitely going to come out of bankruptcy, because there was a stalking horse bid from one of the big PE funds And that basically ensured the survival of the business, and they were going to take it out of bankruptcy. Stalking Horse kind of sets the minimum bid for that, and then we had 15 hedge funds and PE firms like bidding for the company, and so I bought that just before the bidding started, and carried on buying it while the bidding was going on. And some of the guys that were bidding on it were like Howard Marks's Oaktree Capital bidding on it, and Seth Klarman was buying it, and it was just like, wow, this is like the people that wrote the book on distressed debt were buying it. It was great. It was amazing. I went to read up on all the legal cases, even attended the court hearings online over COVID, and that was amazing. But I really became attached to it. I became attached to the investment, and it also became very big, because when it did come out of bankruptcy, it said you could have $5.25 cash, or you can buy shares. I can't remember the dynamic, but basically they said instead of taking the cash, you could pay a bit more and double your shareholding. So I thought, well, it's still incredibly cheap. I'll double my shareholding. And it became like 50% of my holdings or something. But Garrett Motion, they produce turbochargers. And so it's quite a contrarian view that turbochargers, particularly at that time when everyone was going electric car mad, were going to continue surviving for much longer. And you can clearly see that is playing out now, that all the car manufacturers are saying we're not going pure EV at 2030 like we used to say. They're all pushing back on that. And then obviously Trump's come in and said he's definitely not having any of that. So yeah, it was just contrarian play. But the thing is that because all the structure of the investment meant that all these PE firms had such massive holdings, or all these hedge funds had such massive holdings, that it was actually quite illiquid. So the company was starting to use all their free cash flow to buy back shares because it was ridiculously cheap. But the share price just didn't move that much. So while it was obviously a big win, more than went from I bought it at $4.50, $5, and it's kind of sold it at $9.50. So it did very well. Actually, I bought some of it at $3.50. So it did really, really well. But I held it for too long. And it's only recently that I've sold it and moved on to other ideas, because although I still believe in the thesis, it's just the IRR isn't working, because it's just, I was too attached to it. And I kept on thinking, oh, do I sell it now and buy something else? But then I'd be like, oh, what if it went up 50% tomorrow or something, they've got taken out or whatever. And actually that's just being emotionally attached to it. And that's just something I'm aware of and that I don't want to do.
You've got two related to AI, and one of them's also Internet of Things you've put. So QLTU.TA and Pay.br, what are they?
Yeah, so QLTU.TA is Qualitel, and that has been my best investment over the last year. That's been absolutely incredible. They test semiconductor chips. They create special ovens that they do testing for quality and for speed or efficiency. And there's not that many firms offering that. It's quite a small niche market, but obviously it's very, very needed part of the chip development, because you don't want chips that are obviously going to be bad quality or break or whatever. It's also not a very expensive part of the chip development, but they're the niche market leaders, and they've been going since the early 90s. The thing about I really want to invest in tech, and Nvidia looks amazing, it's growing super fast, but the thing with the actual chip development is that the development happens so quickly, and then you've got all the R&D costs and everything, whereas the actual testing and the equipment they use for testing changes very slowly, and they've got patents for. So it's much less dynamic type of market, which it massively reduces the risk. And then they have huge amounts of cash on their balance sheet, and they were very, very cheap when I bought them, and they're still cheap even on a forward earnings basis. They're at about 12 times EBIT for a company that's got an operating margin of 35% and growing. I think they've set to grow next year by 35% or something. It's really, I don't have the figures off the top of my head, but it's big double digits of growth. So you've got that combination of growth and high operating margins, and you've got a clean balance sheet with net cash, excellent management with large insider ownership. And it's just a way of playing on the theme of data centers, which obviously need a huge amount of chips, but you've also got electric cars, you've got solar and wind, you've got Internet of Things, you've got even robotics or whatever, phone and laptops, everything has chips in these days. And you look at Nvidia and the price is going crazy, but actually I think directionally it's correct. Like directionally, we are just going to have chips in everything way more. We're going to have robotics everywhere. And I want exposure to that growth. And I don't want to pay stupid premium for that exposure. So that's one really nice way of playing it. But it's listed in Israel, which makes it difficult for some people to buy it. I couldn't buy it through my ISA. I had to buy it through IBKR, but the investment account, not the ISA. And then the pay.br is Payton Industries. So they do transformers. So like current transforming electrical current from one current to another. But they do special transformers, not the coil ones, but the planar ones, which are like really long, thin strips, thinner than a tenth the size of a hair or something. They're super thin. And again, that technology has been around for a long time, but is actually now being incorporated a lot more, especially in electric cars, because they need the benefit of the planar transformers rather than the coil ones, is that they transfer energy much quicker with less heat and they're lighter. So these kind of things are going to be used more and more in everything, and they're like a bit more expensive than the transformer that you'd find in like some cheap Chinese toy or whatever. But when you're using it with that, they're needed for electric cars or for like data centers or wherever, where efficiency is very important and heat is very important. And they're market leaders and they've been around for a long time. Great insider ownership, got net cash on their balance sheet. And again, that's just another way of playing the AI theme, but they are incredibly cheap, and they still are incredibly cheap because I only bought them fairly recently, and they're trading at net of cash. The Belgian listing is trading at 4.5 times EBIT. So it's just like ridiculously cheap exposure to that great growth theme. And the reason why it's trading so cheap is because it's super illiquid and it's got a dual listing structure. So it's 2/3 of the business is owned by a listing in Israel, and the other third is owned by a listing in Belgium. They have the same identical voting rights, but the Belgium stock is trading at more than a 50% discount to the Israeli listing. And the reason for that is because of illiquidity and also because of the very high withholding tax in Belgium. So the dividends that it's paying out, I think it's 30% withholding tax or something. So that puts off people playing the ARB, but also people couldn't play the ARB because the liquidity isn't there for it. For the fund, I've built up like, I can't remember how much I hold, something like 400K's worth over a 6-week period. So you can build up a decent size, especially for an individual investor, but it just takes time and you have to put limit buys on, not spike the price. I probably shouldn't really be talking about this one because it's just so small, and yeah, but I doubt anyone's going to pay that much attention. So,
Are you still building the position then, or have you now finished?
Yeah, no, I've maxed out. I've gone to the full position size that I can with that because I just think it's unbelievably cheap. But I'm not buying any more, and that's just the way that that's in accordance with my new investment principles. Is that although I would like to continue buying more, I shouldn't.
We talked about it on Twitter. It's been a couple of months ago now, but it sounds nice, but it just goes in the too hard pile for me. I can't wrap my head around it. It's just, I think I mentioned it on Twitter, but I'm quite liberal with the too hard pile. So
yeah, I mean, I find the too hard pile really interesting, and I think that is the biggest pushback on both those investments that I've had, and it's to do with like getting your head around the technology, I guess, or like worrying that it'll become obsolete or disrupted or whatever. I think is that right? Is that your point?
Yeah, essentially, yeah. So I just don't. I mean, I'm not that techie with stuff like that anyway, so I straight away struggle. But like in terms of the moat, how can I possibly assess whether or not that moat is going to be maintained. And the reality is I can't, because I don't really have the knowledge. I could possibly go out and learn a bit more about it. But the time it would take to do that is probably not worth it in most cases. And you're going to have some that slip through the net that are, but I don't know if it's a totally unrelated business. But if I use an example, like the episode that we've just put out as of the time of recording, we've done 3 pharmaceutical businesses, including Novo Nordisk, which has obviously all these wonderful GLP-1 products. And last time we covered it, it was trading at something like 40 times earnings, and the GLP-1 products were going to take over the world. And Terry Smith was selling Diageo because people are going to be having all these GLP-1 products and they're not going to be drinking alcohol anymore because they're going to have no appetite. And then you fast forward a few months, and I don't know whether it's true or not, but the shares have absolutely tanked for Novo Nordisk. And the reason is that there's another company that had done a Super Bowl ad that basically does a similar thing to their GLP-1 products. Not quite the same, doesn't infringe the patents, but I think they're saying they can do it a lot cheaper than the $1,300 a month that you'd have to pay for Novo Nordisk's 2 main drugs on it. And it's just one of them things where it's like, well, how can you possibly assess what the impact of that is going to be unless you've got like incredibly specialized pharmaceutical knowledge? And I know it's not exactly the same, but anything like that, you're getting such a specialized level of knowledge that I kind of feel like if you just avoid everything to do with the industry, you will miss out on more losers than you miss on winners. And it's more just something I got from watching the Buffett and Munger meetings. That it was just an idea that resonated with me quite a lot. And there's just certain industries now where no matter how attractive they are, I just won't touch them because you can't own everything anyway.
Yeah, so I think that's a really interesting perspective, and I think the drug company highlights actually something, that the difference between the risk of the two. So obviously, the drugs company is a new drug for a start. So
yeah,
anything that's new is disruptive, and you don't really know how it's going to behave. If there's going to be more competition, are people going to go off it? Is there going to be an alternative, whatever? Whereas, like, for example, these products have been running since the 90s. So they're not new, and they've been around for ages. And then you kind of look at all the competition that, for example, Intel and, that Intel wars and AMD, they spent huge amounts on R&D. And so the R&D gave you a hint that, well, that is, again, a very disruptive environment. Whereas if you look at the kind of R&D that these 2 companies I mentioned are spending, the R&D is very low. And that's because it's not changing much. So there's not much disruption going on. So I think when you want exposure to a growing industry, you often kind of end up with big changes going on. Whereas if you're in an area or a niche where there aren't actually big changes, but it is growing, that's kind of the bit that I'm aiming for.
Where's the technological improvement then? Because it's rare you get a technology like that where it just stays static for 20 years.
So there isn't a huge amount there is ongoing technological improvement while they're developing new things and they're improving it and then bring out new patents. But what's really driving the growth is the use cases have expanded. And that's really cool. So it's actually just that the industries didn't exist that now are massive growth industries that now require these products. And so when they were just selling these products to various smaller industries that had niche requirements, like maybe very high-end headphones needed planar transformers to get the most exquisite sound out of them. Now it's not just high-end headphones, but it's electric cars, it's data centers. So it's just an expanded universe and demand of the existing product.
But why has no one else gone in and started trying to make them then?
Well, it's too early at the moment, and it requires a huge amount of development time to get to that stage. So it's actually much cheaper to just buy out one of these companies if you wanted to. But even then, if you say, okay, well, there will be more competition in the future, and yeah, there probably will. The niche is the total addressable market that's actually probably preventing new entrants. If the TAM was massive, then you just get a flood of new entrants. But because it's quite niche, there's not actually that much there to play for. So it's just buying cheap in a growth industry. And yeah, I'm sure there will be more competition down the line, but you're going to get a good 5-10 years of very good growth with low competition on an existing product that's got low R&D, and that they're just free cash flowing. Like, in a growth market, you get exposure to that growth, but with the low risk.
What was the valuation again?
On the Payton Planner one, it's 4.5 times EBIT, net of cash and based on the Belgium listing. And
How do
then
you buy it then if it's listed in Belgium?
you can buy it. It's listed on the backwater exchange of Belgium, Euronext. I think I can't remember exactly what it's called.
So you'd have to set up an account with Euronext.
No, I just buy it through Interactive Brokers.
Oh, right. So you could just buy it through a normal account still?
Yeah.
Just with low liquidity?
Yeah, and it only trades twice a day at 11:30 and 2:30 or something like that. I can't.
Did you have to put it? Is it like with a fund or something where you just put in an order and you kind of log in the next day and it's there?
Yeah. I mean, it probably is a bit more liquid than that. It does trade a bit more than that, but it's just that puts people off the liquidity. But for me, the other big thing that changed, and people will say like, oh, it's kind of been stuck around that range for a while. Well, this time last year, the largest PE firm in Israel bought a controlling stake in the business, and they have exposure to other EV in their fund. They have other EV manufacturers and various things, and they are consulting the business to grow. But this Israeli PE firm, they have done a similar investment into a dual listing Israeli and Belgium company, and they've merged the two listings. I'm hoping, and I think it is quite likely, it's definitely a free call option, that they merge the two listings, so they take out the Belgium listing, and then you get 100% upside just from that, or 120% upside just from that, because of the discount that it's trading to the Israeli business. But the Qualitar was traded, I bought it when it was basically the growth was valued at nothing, and I bought it last year, and since then it's gone up like 300%, which is my big winner last year. That's still trading cheap on forward earnings. It's like 12 times EBIT. That's where I'm kind of seeing it. But they're about to, I think next month they'll release their earnings, and then it will be a bit more obvious. I mean, I think that's ridiculously cheap still. 12 times EBIT for a company with like 30-something% operating margins and growing fast, and net cash. Like,
I suspect it's because the market caps, and then just there's not many people willing to go digging under the rocks you're going under, I suspect.
Yeah. Market cap size is definitely a thing. And like when I bought it, it was 85-90 million. So now it's like 300 million or something. And that becomes much more accessible to institutional investors. And so I know one of the guys that I've been talking with on Twitter or X, which is part of the reason I love investing, he's going around talking to big institutional investors in Israel and introducing them to the idea. And I've seen like that was part of the big run up in December, I think, was him introducing it to an institutional investor. And now it's the size that they can actually take a position. Yeah, it's pretty cool. I really like that dynamic of like finding a small cap that's doing well and growing, and then it grows into the size that institutions can start buying, and you get multiple expansion, obviously.
Yeah, it does sound good. I just don't know if I'd have the time. That's the issue.
Yeah, it takes time. It really does. That's part of the fun for me is digging into, well, what does this business do? Like,
it's not a fun issue. It's purely a time issue. Yeah. Whereas I think, because obviously what we're doing is we're mainly covering FTSE 350 businesses, and you kind of know what you're getting. It's like most of the stocks you cover, you know what they do from the beginning. So you might have never looked at it, but I don't need to tell you what Next does. So it just makes it a bit easier, especially when you've only got a certain amount of time per week. But,
yeah, although I'd say like, you say I know what Next does, but there's a lot to research in Next in terms of there are a huge amount of factors that impact it, like stocking issues and, demand trends, fashion. Like
there are, but what I've tended to do is it's probably a change in my own investment philosophy, right? As a consequence of doing the show. But what I used to do before I started the podcast was I'd kind of feel like I had to do all my research in one go and then make a decision. It was very rare. So I think that's part of what happens as well when you're earlier on in your journey and you're still building up a portfolio. Because if you've got 3 stocks that you own and you want to get to 10, everything you come across that you like, it kind of just goes in the portfolio. Whereas once you get to a point where you need to sell something to buy something else, it becomes much more difficult anyway. But what I tend to do is we'll do more like surface. I don't want to say surface level, but we'll just go over the results, and then if we both really like it, me and John, we'll just kind of leave it, and then 6 to 12 months later we'll cover it again. And then if this happens 2 or 3 times and we both really like it, that is then now the trigger for me to say, well, actually, I need to go in and take a proper look at this. So that on its own kind of works so far it's worked as a very good filter, so that you don't have to spend loads of time because you are just coming back to the same businesses rather than doing. And most of the time, I've never actually measured it, but I suspect it has improved the results as well.
I think that approach works really well with cyclical business, actually, because you can find them and you go, oh, that's an interesting business, but maybe not the right price. And you keep tracking it. And then eventually when it gets to a really good price and it's in a down cycle and you can kind of see, oh, maybe the down cycle's coming to an end, it's a great time to buy. And you're kind of already familiar with it. Otherwise, it's too much.
Yeah, it does work very well with certain businesses because I don't use screeners. I just never have. So there's some businesses, obviously, you've got stuff where if you see it and you like it, it goes on your watch list, and then you keep an eye on it. But then you've got some where you might like it, but it's not really a valuation where it would go on the watch list. But doing them on the show, it means that you will come back to it. So, I mean, I wouldn't buy it because I don't understand it. But a good example is Novo Nordisk. Everything I've seen suggests that it's an excellent, excellent business. And we looked at it at 40 and it was just like, oh, no. And then we looked at it last week and it's come down to 21 or something. And it's like, well, I still wouldn't buy it because it's too difficult. But I wouldn't have come across it again doing it the way I used to do it, if that makes sense.
Yeah.
So anyway, that's the end of all my questions. I don't know if you've got anything you'd like to say or where people can find you or if you've got anything you'd like to ask or anything like that before we wrap up.
I'd say one of the things that I found the biggest impact over my investing in the last year and a half, which has actually dramatically improved. I got far better results over the last few years. Like all of the, not just like one big win, but like lots of like all the portfolios done really well. But and I know that some of that's down to luck and whatever, but I think there is genuinely like a change in strategy that's really helped. But I think the thing that's driven that change in strategy or that's made me a better investor is the self-reflection. And, this is one of these things where like people don't really want to talk about like mental health or like looking after yourself mentally or personal growth or whatever. But I think that that's super valuable. And for a good few months last year, I took therapy, video call therapy once a week for 45 minutes. And that was super valuable to me. Like that has made a massive difference in my life as well as investing. And it wasn't that I didn't take therapy because anything particularly bad was going on with me or anything, or I felt like emotionally unstable. I just wanted to kind of dive deeper into all the kind of filters that I hold and the ways that I'm viewing the world to try and get a clearer picture of reality and to try and figure out what's driving me, what do I, and then kind of reassessing that and going, is that appropriate? And it dramatically impacted, the views that I have. And I've still got, a long way to go. And I'm absolutely loving the journey of like that self-reflection, which is carrying on. But I strongly recommend anyone to do therapy or to look into that kind of, self-reflection, because that really, really does, in my opinion, help with what you want and then your reasons, your whys. And I think that drives a lot better results, but not only better results, but just a feeling of more comfort and ease. And I think that's, if everyone had more comfort and ease in their life, that would be a very nice thing. So and I'm not saying I'm perfect at all, because I've got a huge amount of things to work on and go through, but I definitely have noticed the difference. And to combine that with exercise as well. So to really like get out of my head and do exercise, and particularly yoga and flexibility and stuff, as well as cardio and weights. The yoga and flexibility is like the physical flexibility that actually helps me get out of my head and creates more mental flexibility as well. I know that sounds like quite airy-fairy, but seeing the results for me, like, and how it's impacted, I know that it works. So yeah, just thought I'd share that in case anyone found that interesting. But yeah, other than that, that is definitely all that I was hoping to talk about. Thanks, Sam.
For anyone that's enjoyed listening to you, and hopefully there are a few, where can they go to find more about you?
Yeah, my Twitter handle, as you said, or X handle, is Joe Value. And yeah, I have DMs open, so drop me a message if you want. I've also got a link to the Substack on my bio on the Twitter profile, and that we write up ideas occasionally on that. I don't like to put too many ideas, but I will be probably posting a couple in the near term, just because it gets quite good engagement and good, interesting conversations out of it directly mostly from Twitter. But yeah, feel free to drop me a line. Very happy to talk to everyone and hopefully help anyone that I can.
Well, thank you very much for coming back on the show. I think you've had quite an interesting couple of years since we last spoke, by the sounds of it. But I do find what you're doing with the financial advice firm really, really interesting. Just because, I mean, I've been working in personal tax for 8 years, something like that, and I'm not exaggerating. I haven't come across a single financial advisor that I would be comfortable giving my own money. I think industry-wide, I think there's a lot of problems with the industry. And I do think what you're doing is incredibly refreshing, and I think it is good to see someone that is actually interested in investing doing it, rather than someone who's just picking it as a career. I think to have gone into it with your investing background, I think it does give you, for me, it gives you an edge over pretty much everyone else I've come over. So I do hope it goes very, very well for you.
Thanks, Sam. Really appreciate that.
So thank you very much for listening, everyone, and we will see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.